Good afternoon, everybody. This is Patrick MontesDeOca, CEO of EMA2TradeLifeSignals.com. I would like to thank everybody for taking the time out to come and join us here at the EMA2Trade Live trading room and share with you the variable changing price momentum indicator VCPMI automated systems, which are showcased in TradeStation platform. Algorithmic trading systems use mathematical models to analyze financial markets to determine when to buy and sell, as well as to execute and manage orders once they have been placed. Manually operated by human traders, partially automated by human traders, and algorithms are fully automated through the use of algorithms and artificial intelligence. Technical analysis, a traditional analytical approach that determines what a security is worth at a given point in time, uses historical prices and indicators to identify zones of supply and demand where buyers and sellers are likely to change the price of the financial product. Quantitative analysis uses mathematical and probabilistic models to make predictions about future movements of a market. Hello, everybody. My name again is Patrick MontesDeOca. I'm a widely published technical analyst, author, commodity trader, trading coach, and systems developer with expertise in algorithmic intelligence and computer modeling of processes. I custom build proprietary market intelligence reports that are customized for each individual or institution's trading objectives. After more than 30 years in the financial markets business, I have developed a unique and automated trading tool based on a combination of Elliott Wave, Fibonacci, Degan, and Vedic Mathematics. This proprietary trading tool, the VC Price Momentum Indicator, is a revolutionary trading tool that identifies major cyclical changes and trading opportunities in the commodities and financial markets with unprecedented accuracy. Some of the reports that we have published, you can see them in Trader Planet, investing.com, and Seeking Alpha. You can also see some of the podcasts and video reports that we publish weekly in our channel on YouTube. The Variable Changing Price Momentum Indicator, VCPMI system, is an intelligent automated algorithmic trading system developed over a decade. The primary driver is the principle of reversion to the mean, combined with a range of analytical tools including fundamental logic, wave counts, Fibonacci ratios, Gann, principal, supply and demand levels, pivot points, moving averages, and momentum indicators. The science of Vedic Mathematics is used to combine these various elements into a comprehensive, accurate, and highly predictive system. How and why the VCPMI was developed? By identifying the average price, mean, or equilibrium of price action based on yesterday's supply and demand factors, we can extrapolate the extreme above this average price and the extreme below it prospectively. Mean reversion trading seeks to capitalize on extreme changes in the pricing of a security based on the assumption that it will revert to its previous state. It can be applied to both buying and selling. allows a trader to profit on unexpected swings and save during abnormal lows. The VCPMI creates a specific set of instructions to execute subject to certain criteria being met. When the signal is executed, it will automatically produce a specific price target objective and a protective stop to go back to a neutral position and wait for the next signal. Emotions without structure can be devastating. VCPMI lets you trade without emotion or judgment. In trading, emotions without a structure can be devastating. Once emotions are out of the equation, the VCPMI does the quantitative analysis using daily, weekly, and monthly data and provides a specific structure for each market trend so you can then trade with confidence and accuracy. Your responsibility is simply to ensure the VCPMI is working properly, execute the trades based on the signals as laid out by the VCPMI indicators. The VCPMI can be used for short-term, intermediate, and long-term traders. It produces a trading structure of 5 levels of supply and demand daily, weekly, and monthly for all types of traders. Identifies the average price structure for tomorrow's market using yesterday's supply and demand data. It will quantify where the extreme above or below the mean will occur for the next trading session. When prices trade at these extreme levels, it is 90 to 95% probable that prices will revert back to the mean by the end of the trading session. Trend traders. A swing trading, a short-term trading method can be used to trade stocks and options. Swing trading, hold positions 2 to 6 days, but sometimes as long as 2 weeks. Day trading, hold positions for a day or less. Position traders, buy and hold. Buy stocks and hold them for a long period of time, regardless of fluctuations in the market. Actively selects stocks, but once in a position, is not concerned with short-term price movements and technical indicators. VCPMI components. Moving averages. Pivot points. One of the highlights of the VCPMI is the VCPMI is composed of a pivot point, which is the average price, and 2 higher pivot point resistance levels known as sell S1 and S2, and 2 lower pivot point support levels known as B1 and B2. And we'll get more into detail a little further down into the webinar here. One of the things that we use here, one of the metrics that we use is the Fibonacci ratios in wave structure. Fibonacci ratios are the numbers in the following integer sequence. You can see down here that they start with 1, 1, 2, 3, 5, 8, 13. Every number after the first 2 is the sum of the 2 preceding ones. Named after its Italian creator, Leonardo Fibonacci, about 1175 AD to 1250 AD. Each term is the sequence. Each term in the sequence is the sum of the 2 preceding terms. Golden ratio. A special ratio that can be used to describe the proportions of everything from nature's smallest building blocks, such as atoms, to the most advanced patterns in the universe, such as unimaginable large celestial bodies. And the golden ratio also applies to the financial markets. In the Fibonacci sequence, the sequence, it's not that important, as we have discovered. What the key is the quotient of the adjacent terms, basically roughly 1.618, or its inverse, which is 0.618, which most of us know it as pi. Almost everything has dimensional properties that adhere to the ratio of pi. Elliott waves and the VCPMI wave theory. The following is from R.N. Elliott's book, The Nature of Things. Quote, human emotions are rhythmical. They move in waves of a definite number in direction. The phenomenon occurs in all human activities, whether it is business, politics, or the pursuit of pleasure. It is particularly evident in those free markets where public participation in price movement is extensive. Bond, stock, and commodity prices trends and therefore specially subject to examination and demonstration of the wave movement. These treatise has made use of price movements in stocks to illustrate the phenomenon, but all the principles laid down herein are equally applicable to the wave movement in every field where human endeavor is registered. A complete movement consists of 5 waves. Why this should be 5 rather than some other number is one of the secrets of the universe. No attempt would be made to explain it, although in passing it might be observed that the figure 5 is prominent in other basic patterns of nature. End of quote. Vortex wave cycles. Laws rule the universe. Gravity, magnetism, thermodynamics, physical laws. The Elliott wave principle is based on this principle and on the knowledge developed by Fibonacci about his sequence. The base of his knowledge came from observations made and recorded thousands of years ago in the Vedas. Hindu scientific and sacred books about mathematics, science, government, and religion. In Vedic Mathematics, the energy of everything in the universe is measured in a scale from 1 to 9. These energies are called vortex wave cycles. They represent a particular energy associated with every natural object, including stocks. Elliott had an idea of the vortex wave cycles, which represent the movement of all life in 9 waves. Elliott counted only 8 waves, not 9. He was certain about the first 5 waves, but unsure about the movements of the last 3. He missed the 9-wave movement in his theory, which meant he was never able to accurately predict the full movement of the waves. To track the movements of the universe in the form of waves, we must consider the factor of death or termination, or there will never be a beginning. William Degan, the master trader, born in 1878 in Lufkin, Texas, his technical analysis methods for predicting both price and time targets are unique. It netted over $50 million during his trading career. Success rate of more than 90%. Gann could be very well have been right all the time. Any losses incurred in him were only there by his own design and not because of any faults with his methods. There are numerous examples of his trading success, and you can see them here. 1908, $100 account increased to $12,000 in 30 days. 1923, $973 account increased to $30,000 in 60 days. 1933, 479 trades were made, 422 profitable, accuracy of 88%, 4,000 profit. And in 1946, 3-month net profit of 13,000 from starting capital of 4,500, a 400% profit. In the December 1909 issue of Ticket magazine by R.D. Wyckoff about Gann, one of the most astonishing calculations made by W. Gann was during the last summer when he predicted the September wheat could sell at 120. By the close of the market, it will prove that this is something, if it doesn't close there, he felt that it was something wrong with the method of calculations. He didn't care to look at the price except on the close, and it must go there. It is common history that the September wheat surprised the whole country by but selling at 120 and no high in the very last hour of trading, closing at that figure. Gann's trading methods are based on personal beliefs of natural order for everything in the universe. Family had strong religious beliefs, often used biblical passages, often quoted Ecclesiastes 1, 9, 10, what has been, that will be, what has been done, that will be done. Nothing is new under the sun, even the thing of which we say, see, this is new, has already existed in the ages that preceded us. The predictable movements of price result from the influence of mathematical points of forces around the nature and what is the cause of all these points of forces, right? A cosmos, universe, all planets around us. Time is a factor that determines the length of a commodity's price trend. What time dictates that trending prices should react. Prices may stabilize for a short period of time and may fluctuate within a tight range, but eventually they will react by reversing direction. One of the things that Gann used was the 30-year 360-degree movement of the Earth around the Sun, which was measured by a similar, not exact number of days. And we'll get into this and see how the program basically utilizes and converts all of these numbers into a specific indicator, which is the total end result in digital. The end digital form of the code is what we will identify with you in a bit. So in distant past, a solar year, for example, may have been comprised 360 days. Biblical references support the concept of a 360-day year. A complete orbit of the Earth around the Sun is 360 degrees. A single day represents slightly less than a single degree, 0.9856, but close enough for this purpose. The primary divisions of a circle are 90 and 180 degrees. They equate to the primary divisions of a year, 90-degree seasons and 180 degrees between solstices and or equinox. The average 91-day session equates to 89.69 degrees of orbital movement, very close to 90 degrees. These periods are monitored closely. 30-degree movements are the exact 30-day period or 1 month movement, i.e. from the 18th of 1 month to the 18th of the ensuing month, and are also significant. 12 30-degree movements in a circle or orbit, and 12 of these degrees movements from the 18th of 1 month to the 18th of the next year in 1 year. We're going to explain to you how we do the weekly, monthly, and daily reports by using this information as well, and how we are able to use this and also obtain the inversion structure within this time frame. The same is true for all 30-degree multiples, although some, 60 and 120 degrees, seem to have greater significance and predictive potential than others, 150 and 210 degrees. The market instruments that we trade basically are gold, silver, soybeans, E-mini, S&P, crude oil, and we trade 3 ETFs, JNUG, USLV, and SPY on the automated system. How to identify the signal. The day trading program is applied to 15-minute charts and can be applied to other time frames depending on the product. In each case, the basic algorithm is the same. The variable is the end-day VCPMI pivot. Results of the supply or demand levels are calculated from the previous day, called pivot points. Once these levels are calculated for the following day, week, or month, the VCPMI identifies specific price levels. Any of these price levels is called end day or pivot. The program on any given day can be in one of 4 states: wait, neutral, long, or short. At the end of a trading session, the program will transition between states. The program, in general, starts in the wait state. When the daily price action from the previous close in today's close crosses the end day VCPMI, a set price point in the market, it transitions from the wait state to the neutral state. The end day VCPMI is referred to as the pivot and will vary by product. The VCPMI self-directed structure. It gives you the exit long levels above the mean. Cell 2 is the second level extreme above the mean. The cell 1 is the first level above the mean. And we identify these levels in red to identify the supply. The VC price momentum indicator in green is the VCPMI pivot point or the mean indicator. And this is the average price that allows us to quantify the extreme above the mean of cell 1 and cell 2, or the extreme below the mean of buy 1 and buy 2. The neutral signal is enabled initially by the price action crossing the pivot level, activating a new setup is in place. Using the next 15-minute bar for the day session close, it triggers the actual signal, starting with the VCPMI daily point as an example. Putting it all together, the VCPMI automated trading system was designed to do everything for you. The proprietary model incorporates Elliott Wave, Fibonacci, Vedic, and Western mathematical principles to monitor cycles and identify volatility, momentum, and patterns. The VCPMI are a subset of support and resistance levels. This special form of projected support and demand and resistance supply form the basic methodology used by the VCPMI proprietary algorithm. The basis of defining expectations for tomorrow's trading are the historical support and resistance levels. Using these prices as an input for our proprietary algorithm produces the most powerful anticipated buy or sell levels on tomorrow's trading session, called the VCPMI. Our system then can extrapolate how far the market is likely to move up or down from the VCPMI levels in the preceding session with between 90 and 95% accuracy. The sell 1 and sell 2, buy 1 and buy 2 levels. This is the report that you receive a day before the trading session, a week or a month before the trading session, that gives you an idea of the extreme above the mean. It identifies the mean or the average price for you, and also the extreme below the mean. The first projected anticipated level of resistance is the supply above the VCPMI, called sell 1 or sell 2. The next higher resistance levels are the sell 2. The first level of projected support demand is B1 under the VCPMI. The next lower level of support is B2. During the upcoming trading session, unless the price action is influenced by unprecedented outside forces such as an economic report or news, our model will revert to its mean between these calculated points. If today's price action starts above the VCPMI level, it will tend to stay above the VCPMI, also called the daily pivot point, average price, or mean of the day's activity. So in this case, the market closing at 1529, using the example that we have here on a report that we published on November 17, with the market closing below 1774, came in with a trend momentum that was bearish. But it also tells you that if you close above the 9-day moving average of 1774, that it would negate this bearish sentiment. And so this is the first level that you can use as your protective stop, as your protective level, or an indication that the short-term trend momentum might be shifting. The second filter that we use basically is the weekly price momentum, the VCPMI weekly price momentum indicator, in this case being 1563. And with the market closing below 1563, it was telling us that we have a bearish sentiment in the market. And by closing below 1563, it has activated the stops of 1470 to 1419. We're doing a report on JNUG right now to show you basically that the algorithm can be applied for futures, for stocks, for ETFs, using the same algorithm, and the individual criteria of each market will be basically used to provide the same structure that you see here in JNUG. And this report, by closing below 1563, was telling us that the market can come down to 1470 to 1419 from the 17th, and you should cover any short positions at 1470 to 1419 levels and go long on a weekly reversal stop. It tells you automatically where, when you go long, where to put the stop, and your stop on a weekly basis should be 1419. The stop should be on a close only and good till cancel basis, which means that in order for you to get stopped out, the market has to close below 1419. It also tells you on the other side that if we go above 1563, to take profits at 1614 to 1707. We're going to take a look at the TradeStation Live platform that we have right now, and basically see how we use this information in real time. This is the chart that you're looking at for JNUG in real time, and as you can see here, I'm going to zoom in a little more so we can see clearly the signal being activated and when it's activated. What you see here is the levels that we have of supply and demand, and we get 2 levels above for supply and 2 levels below for demand. And the methodology basically is that the blue level identifies the highest probability, as I mentioned to you before, with about a 90% probability that if the market comes down into these levels, that it would activate a buy signal. And you can see here the market coming down into that B2 level and activating an automated buy signal, with the target automatically being the level above. And if you have multiple positions, you can use the target, the next target above, and in this case, the VCPMI in green. Each of these fractals represent a day's trading activity. And you can see here when the price pretty much got up to the sell or the red levels that we call supply of sell 1, it automatically activated a short position. And your stop automatically is the level above. If it closes above, you can get stopped out and go neutral again. The target is the level above below, and in this case, going short from sell 1 activated the target, which was the code in green, which you can see here was activated and executed as expected. So we have a structure that we trade basically the inversion to the mean. When the market is at the extreme above the mean that we can identify here in green, the algorithm automatically analyzes the market action in relation to the metrics, the algorithms that we use, and executes a signal automatically, as you can see here. Once the signal is executed, then we run it into what we call a performance summary, and you can see here basically the performance since we started trading the automated account, which is in March 15, to today's activity, which is December the 4th. This is basically documented in our TradeStation platform. This is the total summary of all the activity that we have done in the automated program. The return on initial capital is 473% in 8 months, 20 days, 2 hours and 59 minutes, averaging an annual rate of return of 241%. You can see here the documented trades that we have done. And you can examine the fact that we do take losses as well. The program is not guaranteed to make profits all the time, but we produce a substantial amount of what I call positive returns by following the algorithm as it is directed. One of the things that I would like to share with you is basically, since we started trading the algorithm in March 15, prior to that, we traded the algorithm on a semi-automatic basis. And if you go to eMa2TradeLiveSignals.com and you go to Trade Record, you click on Simulation Historical Performance, you can see the historical performance of every trade that was executed manually since the program was initiated in 2012 until March of this year, when we basically went completely automated and the algorithm is showcased in the TradeStation platform. You can check the history, the backtesting history, you might say, of this prospective trading that you see here. We have documented all the trades from day trading to swing trading. You can go here, look at the trades month to month, year to year, and we document the trades with time and price, the date, quantity. So we're pretty transparent in terms of the documentation of the program, so that you can have a very clear picture, a very transparent picture of how you can use this to benefit on your own trading. If you have any questions at all, please, it's a good time here to stop here for a minute and see if you do have any questions at all. I'd be more than glad to answer any questions that you may have.